Thanks for having me. I think since we're in a classroom setting, as Mike said, we can make this very interactive. I'll make a few opening remarks and kind of sketch out what we did and why we did it as quickly as I can with the clock back there to remind me what time it is, and then love to take your questions on any aspect of this. I'll start at the end, actually, because when GM went public that day, I had agreed to co-host CNBC and was sitting on the set of CNBC as the various GM executives and floor people, and the bell rang, and the first share was traded and all that, and it was an amazing moment after all the ups and downs and all the work and all the effort, even though we had felt very good about what we had done, to actually see it validated by the market was really quite a moment. So before I go back in time, I do want to just amplify on Mike's recognition of Clay Calhoun, who's sitting over here, because you'll all want to read this book because Clay is very prominently mentioned in it. He's actually in the index. But I want to just read one paragraph about this came up in the sort of middle in the frenzy when we were trying to get Chrysler and Fiat all on the same page, and they had different sets of projections, and we basically said, you guys have a weekend to figure this thing out. And I didn't want to spend the weekend in Detroit. Ron Bloom, my deputy, didn't want to spend the weekend in Detroit. So we sent Clay and another fellow called Brian Asias. And so this little paragraph begins on Saturday morning. So by 11 a.m. on Saturday morning, Asias and Calhoun convened more than 24 Fiat and Chrysler executives and advisors around the large table in Chrysler's 15th floor boardroom. The executives were almost all middle-aged industry veterans. Asias was 32 years old and Calhoun was 26, and both looked younger than their years. We're going to sit at this table until we're done, Calhoun announced. There's much more about Clay here. You should all get this book and read it to find all this. I'm sorry, Clay, I didn't mean to embarrass you like that. But Clay and I worked together at Quadrangle, and he was a superstar there. And so when I went to Washington to take this job, and he said, asked me if we were looking for help, and I said we're looking for all kinds of help, and I was really delighted that he joined us. And like all the rest of our team, he did a fabulous job. So let me just, as I said, try to do two things in a short amount of time, and so I'll speak reasonably quickly, and then we can open up. Let me just give you a kind of a quick chronology for those of you who didn't follow autos all that closely, and I can't blame you for not. And then let me give you a few sort of the takeaways from the project that I would love you to all leave the room thinking about, and then, as I said, we can have a discussion. I think probably most of you remember the sort of first big public event in the auto crisis in November of 2008, when the three executives flew to Washington to testify in front of Congress in their separate planes. And that's the part everybody remembers. What people don't remember as well is they showed up having GM and Chrysler particularly having kind of frankly suddenly discovered that they were about to run out of money, having just as suddenly told the Bush administration that they were running out of money, and then being sent to Congress by Secretary Paulson, and appearing there with essentially no plan, no idea what they were going to do with the money, and no sort of recognition of any sort of culpability in the fact that they had run out of money. There was a lot of toing and froing at the end of 2008. Obviously, there had been a presidential election. It was a lame duck administration. There was a banking crisis going on. But President Bush and Congress ultimately just failed to act. They just couldn't pull themselves together to do anything about autos at that point. President Bush, in my opinion, quite correctly, made a decision that the auto companies were not going to fail on his watch. And so one of his kind of SWAT teams of ex-Goldman guys that he brought in sort of pulled together in December of 2008 and provided bridge loans of about $17 billion to GM and to Chrysler to sort of get them over the end of the year, get them into 2009 when the new team was going to arrive, and would hopefully then have the time, the bandwidth, which is kind of the energy, frankly, to address the problem. And as I said, I think given the situation at that point, the end of an 8-year presidency, a lot of very tired people, I think the Bush people did about as good a job as you can do under the circumstances. President-elect Obama then, of course, realized that he had to deal with this problem, and after some deliberation, decided they would set up a separate task force to do this. There were two reasons really for that. One, they knew that the economic and financial crisis was going to occupy all of the people who had sort of the traditional jobs of undersecretary of this or assistant secretary of that within Treasury or within Commerce, within the White House. And the second reason they did it, which is an interesting reflection on how our government works, is that we had no auto expertise in the government, really. For that matter, we had no real industrial expertise, and I don't say that critically, but in this country, relative to some European countries and other countries, we really have tried to stay out as a government from the industrial sector. And so part of that is not really having people whose job it is to understand industry in general or even specific industries. And so there were a couple people in the Commerce Department who kind of monitored auto imports, and we later found out there were a few people over at the Fed who actually were pretty good at forecasting auto sales in general, but there was really nobody in the entire government who knew anything about autos. And of course, I didn't know anything about autos either, but that's a different matter. So they decided to set up this team, and they did come to me. And so you may say, why did they come to me? And that would be a very valid question. And the short answer is because Tim Geithner and Larry Summers, the two guys who Clay and I and the rest of our team worked for directly, as well as obviously indirectly the president, they had the view that this was not a management job. We were not being hired to run these companies. We were not being hired to decide what the next new car should be or what cars they should make. It was really a financial restructuring exercise. We were being hired, and a private equity exercise for that matter. We were being hired to basically look at these companies and figure out how to take them from the disastrous place they were and restructure them into something that could be viable. And by the way, we knew that we were going to be making a very significant additional investment of government money. And so it was a private equity exercise in the sense that we were investing all of your money, taxpayers' money, and we needed to try to figure out whether this was a good investment or not and be able to tell the president and his other senior advisors in the White House what we thought was likely to happen. So they looked at me and Clay and the rest of us who ultimately arrived as a restructuring team. I was not the most experienced restructuring guy in the world either, but because of my political involvement, they felt that since this was going to be an exercise that occurred in the political arena, even though there was a great commitment to having it being done in a thoughtful way, that having someone who had a sense of the politics of it all would be helpful, as well as the financial, hopefully the financial skills. We were on an incredibly tight time frame because, as I said, they had been given a relatively small amount of money, $17 billion, to get them through essentially the first quarter of 2009 through the end of March. So I didn't really even start doing anything until January of 2009. My appointment wasn't announced till late February of 2009. The rest of the team really didn't come together until early March of 2009. You guys take a seat if you want. Till March of 2009. And so we were operating on this really tight time frame, tighter than any project I think I've ever worked on, and with a relatively small team. We ended up with 14 of us, mostly people like Clay and me who had come from Wall Street because they wanted to serve, but some policy people as well. And that, by the standards of what we were being asked to do, was an exceptionally small team. I remember one of my reservations about taking the job was, how are we going to find the people and get the people we needed to do this? And Larry Summers said to me in one of my early meetings, how many people do you think you need? And I said, in a private sector context, I think 50. Here, maybe 15. And he said, well, my whole staff is only 19. And I said, well, that may be, but we need 15 to do this job. And so we ended up having 14. We got essentially what we needed. But it was, as I said, I think J.P. Morgan, you mentioned David Topper, was working on this in Morgan Stanley, and they had dozens and dozens of people. So it was a very lean team. From the beginning, there were two principles that the president and Larry Summers and Tim Geithner decided that were really critical to our efforts and to the success of our efforts. The first was that the only money that we wanted to put in and hoped to put in was in the context of a fundamental restructure to make the companies viable. They decided, and I was really pleased that they did, that they didn't want to kick the can down the road anymore. They didn't want to try to paper it over. They didn't want to try to just get to the next election. They wanted, whatever we did, they wanted it to be something that made these companies viable again. And the second important principle that we established early on, and they stood by throughout this, was shared sacrifice. That this was not going to be done on the backs of the UAW alone. It was not going to be done on the backs of the creditors alone or on the dealers or the suppliers, but that we were going to try to get everybody to the table and get everybody to recognize that they were not the only ones who were being asked to sacrifice. And that turned out, both of those principles turned out to be very important ones. So we plunged in. As I've acknowledged, I didn't know anything about autos, so we approached this with fresh eyes. We had all kinds of, every expert wanted to come and tell us their views about the auto industry. We met with an awful lot of them. We listened to everybody's thoughts. We pushed back. We certainly spent time with the companies. This is all sort of now in March of 2009, because we knew that by the end of March, the president had to tell the country what he was going to do about the auto situation. And by March 25th or so, we had pretty much the essential elements ready for the president to decide. The toughest decision that the president had to make really was whether to save Chrysler or not. We knew pretty well that we were going to save GM. GM was too big, too important, and what we thought of as a real company that needed to be saved. Chrysler was a tougher call. It was, as you know, probably the third largest and third of three American auto companies. It was only a North American player. It had been owned for 7 years by Daimler and then for a couple of years by Cerberus, and had been pretty well hollowed out. It didn't have a single car that was on Consumer Reports' most recommended list. And there was a strong part of our group that actually made a very passionate and very logical and analytically sound argument that Chrysler should be let to fail. That what was capitalism about if not letting weak companies fail? Why was the government putting a lot of money into an old industry company? And I guess I should recognize that I'm in the heart of new industry land here, and so maybe you all don't think we should have saved any auto companies, but put the money in Google instead. But there was that argument that if the government has limited dollars, which of course it has, they should be allocated to newer industries that might have greater growth prospects. On the other side of the argument, the economy was losing 600,000 or 700,000 jobs a month at this point. The immediate impact of Chrysler shutting down would have been around 300,000 jobs lost, only a small part of those from Chrysler itself, but you then had suppliers, you had dealers, you had all the people who service this company and so on. And while I don't believe that we would have saved Chrysler simply because of those jobs, as I said, if we determined that Chrysler was not viable, I think the president would have agreed with a recommendation to let it liquidate. But after a lot of hard work, I think everybody on the team agreed that Chrysler could be viable and that the government could get its money back from Chrysler. It was more a question of whether it was something the government should do. Among the points that the people who thought Chrysler should be allowed to go made was that if Chrysler went out of business, what we learned as we learned about the industry was that a disproportionate amount of Chrysler sales would have gone to Ford and GM relative to the foreign companies, because the product lineup of Chrysler, minivans, trucks, things like that, where they were strongest, lined up best with Ford and GM. So in effect, we knew we were going to be a big shareholder in GM, or a big investor anyway. By letting Chrysler go, we would make the value of that investment greater. But, of course, then you'd have all those jobs lost. So it was a very passionate, hard-fought debate that went really, as I said, right to the president and to 2 meetings in the White House on the 25th or 6th of March. And at the end of hearing it all, the president came down where a slight majority of our group had come down, which was to provide Chrysler with additional money if it could meet a series of very tough tests in terms of concessions, in terms of a business plan that we could back, in terms of an alliance with Fiat, because we didn't feel that Chrysler could exist simply as a North American player. We felt it needed a global alliance, and Fiat was the company that had come forward that we thought made the most sense. And so it was still not a done deal, but at least all things being accomplished, the president agreed that we would save Chrysler. So he gave the speech on March 30th that probably all of you remember. In addition to the announcement about Chrysler and the announcement that we were going to try to save GM, but still had work to do, he also announced that Rick Wagoner was going to be stepping down as chairman of GM. This, to us, was the most obvious decision that the president had to make. GM had lost $30 billion of cash in the 15 months of 2008 and the first quarter of 2009. As I said earlier, when Rick appeared in front of the Senate in November of 2008, there was no plan, there was no sense of responsibility. It didn't get any better. The plan that GM submitted to us in February of 2009 still didn't show us that they had a sense as to how they were going to become profitable and viable again. And we simply believed that under those circumstances, there needed to be a change in management. Rick is a very decent, hardworking, smart guy who is totally dedicated to the company. But we were thinking about this in a private equity context in which management really does matter. And so we felt and recommended to the president that there be a change in management. And with really almost no discussion, which is not meant as any disrespect to Rick, the president agreed with that. Mike was nice enough to hand out an article I wrote recently about the role of management, which related to Steve Jobs' last leave of absence. And I'm happy to talk about that a bit in the Q&A, because one of the things I've always believed in both the investment banking and the private equity business is that the jockey is as important as the horse, that it's important to have a good business, but who the CEO is and who the top management team are is also important. And so we felt that we could not really recommend in good conscience to the president putting more money into GM unless there was a change in management. So as everybody knows, we ended up putting both companies into bankruptcy. A lot of folks said it couldn't be done. A lot of folks said that we broke bankruptcy law, or we made new law, or the heavy hand of government. I'm happy to talk about all that. But needless to say, we believe that everything we did was in conformity with the law. In fact, it was litigated all the way to the Supreme Court. I don't think when I went to Washington I ever imagined that I would be worrying about a Supreme Court decision as part of my job, but there we were. And at the end, it was all approved in every step of the way. And we got GM and Chrysler in and out of bankruptcy in essentially record time, 42 days for Chrysler and 39 days for GM. I think, as you know, since then it's worked out quite well. We talked about the GM IPO briefly, but the GM IPO simply symbolized the recovery that the two companies have made. The bankruptcy process was really essential to giving these companies a fresh start. In the case of GM, we took their liabilities from $120 billion to $55 billion. We took $8 billion a year of annual operating costs out of their North America division. And this was all accomplished by the kind of shared sacrifice that I alluded to before, in which everybody came to the table willing to make, grudgingly. It was hard fought, it was difficult, but in the end, willing to make changes. I remember one of our early meetings with the UAW when Ron Gettelfinger, who was then the president, basically said to us, and actually this was in Detroit at Solidarity House, said to us, look, we're willing to do something here because I, Ron Gettelfinger, understand that if we don't cooperate, these companies may disappear. But we feel like we've been asked to sacrifice in the past, which they had, and we feel like we're the only ones who've been asked to sacrifice, and we want to see other people asked to sacrifice. And so it was that concept of shared sacrifice that allowed us to make more progress with the cost structure and liability structure of these companies than people have been able to make before. It really, a lot of it relates back to that famous saying of Rahm Emanuel's, which actually was not his, but he said who said it first, but I can't remember, which is never let a crisis go to waste. That we had this atmosphere of crisis. We had everybody realizing that without pulling together and making this work, it would be a disaster. And so we were fortunate to have that going for us. One of the other principles that we established early on was that the government was going to get in and get out as quickly as possible. It was going to be kind of the opposite of Vietnam. We didn't want to be mired in the car business. And so we established early on private sector boards for these companies, and we really looked for directors who had exactly the right skills. It wasn't an effort to create a sort of Noah's Ark compendium of two of everything. It was an effort to put together a mix of former CEOs and private equity people who really could oversee these companies. And so as you see GM and Chrysler going forward now, both very successfully, a lot of the credit goes not only to the new management teams at the two companies, but also to the new boards of directors who have been really tough and have just instilled a whole new aura of corporate governance at these companies. GM in particular had terrible corporate governance. One of our colleagues liked to, I shouldn't say this in front of the cameras, but liked to speak of the GM directors in very disparaging terms. Happily, we, as I said, have made those changes. And the new management teams have done a great job. A lot of these old industry practices, some of which actually had logic in terms of the structural problems of the industry, led the companies to do things that made no sense, like have too much inventory on the dealers' lots, like the famous incentives and the zero financing and all that stuff where they couldn't make money in the end. There were reasons why they did all that, so it wasn't as crazy as it seemed. But by changing their balance sheets and changing their cost structures, we essentially gave them a reason to operate in a more logical, rational business way, and that's what they're doing. Inventories are under control, incentives are under control, and most importantly, through the restructuring, we dramatically changed the break-even of these companies. So GM, prior to the restructuring, really couldn't make money unless 16 or 17 million cars a year were sold in this country, which is something that's only occurred a few times in our history. After the restructuring, GM could make money in a 10 to 11 million car sale environment. And so standing here today with car sales running about 12.5 million, they were actually 11.5 million for last year. GM last year had its first annual profit since 2004 and its highest profit since 1999. So even with car sales still very depressed, GM is making substantial net income, and Chrysler is actually making pretty good operating profits, although not yet net income. And I continue to be very optimistic, if for no other very simple reason, that we need to sell 15 million cars a year in this country simply to keep the fleet from aging. In other words, to deal with replacing cars on the road plus a small addition of new drivers every year is roughly a 15 million car sale rate. For the last 3 years, we've been below that, well below that in 2008. And so this is the first time in history that essentially more cars have been scrapped than have actually been sold. So that whole situation is not a long-term sustainable one, in my opinion. And I think car sales will continue to climb. I think they'll be somewhere between 13 and 14 million this year, and then just keep going. And given the changes in the cost structure of these companies, they can make a lot of money, as GM already has, as car sales go up even just a little bit because of the operating leverage that's inherent in them. So let me quickly run through sort of what I think are the takeaways. If you kind of want to leave the room sort of with a thought about what does this all mean, this is sort of what I think it all means. And I think I have about 6 of them. First, that this really could not have happened without the president's insistence on shared sacrifice and on only putting money in if the companies could be viable. That is not intended to be a political, statement or endorsement or whatever. I'm off the government payroll. It's what I actually believe, that without that kind of support, in the face of what a lot of people thought would be enormous pressure from labor, for example, to be less tough, I don't think we could have done this. Secondly, we were able to do this, for that reason, we were able to do this just almost exactly as if we were in the private sector. As I said, we approached this as a private equity investment exercise. We made all the same kind of decisions and did the same kind of analysis that we would have in the private sector, although obviously in a different, under a different spotlight. And I think we, as a result, invested the taxpayer dollars wisely. Thirdly, as I said before, contrary to what some of you may have read or think, and again, happy to debate it, everything we did was not only legal, but in accordance with precedent and in accordance with, I think, fair treatment of all the stakeholders. Fourth, as I said, management really matters. And I mentioned the decision about Rick. We made a similar decision in the case of Chrysler, that we felt that management was critical and a key part of the alliance with Fiat, and in deciding to partner up with Fiat was the fact that Sergio Marchionne was the CEO of Fiat, and Sergio, who was not also a lifelong auto guy, had done a great job of turning Fiat around, which had been a very troubled auto company, had actually done very poorly in the U.S. in particular, which they exited. But Sergio had done a great job, and we really felt that Sergio was a jockey that we could bet on. And so you now, in Detroit, have this rather interesting situation of three, the so-called Big Three, which they now call the Detroit Three because they're not so big anymore, all being run by people who are not from Detroit, two of whom, Mullally and Dan Ackerson, who's the current CEO of GM, are not auto guys, and Sergio, who is certainly not a typical auto guy or a lifelong auto guy. And so even though we certainly got a lot of blowback from the auto community about who were we, a bunch of non-auto guys, and who was Ackerson, and who, and all this kind of stuff, I think that having fresh blood in this industry has turned out to be the right decision. Bill Ford, who I only met after this was all over because Ford really was not under our care, gave a speech in about, I think, 2006 or 7, right about the time he brought Mullally in, which I mentioned in the book, in which he basically said we're an insular company in an insular industry in an insular town. And it was something that very few people in Detroit would acknowledge or recognize, but Bill Ford did and made that decision to bring in Alan Mullally. And it was a really smart decision. It was a very humble decision. And I think it was a very important moment of sort of introspection on Bill's part. The fifth point I just want to leave you with, which is more of a Washington point, but I assume some of you are interested in, or all of you hopefully interested in, how our political process works, is that we could not have done what we did without the existence of TARP. I'm sure you all know what TARP is, the $700 billion financial rescue fund that was passed actually under President Bush's watch, even though President Obama now gets blamed for it. But it was probably the single, I call it the single most important piece of economic legislation in certainly my lifetime, because it gave the Secretary of the Treasury the ability to deploy $700 million. It was actually never all used. I think only about $450 billion was used to save the financial sector and to save the auto sector, where we put $82 billion. Without TARP, either administration, both administrations, would have had to have gone to Capitol Hill for every appropriation for every dollar that went into the banks or that went into the auto companies. And having now spent a good bit of time in Washington, I have no doubt that Congress would have never pulled itself together to appropriate that money in any kind of timely way. And you would have had a meltdown in the banking sector. We would have not had the money to save the auto sector. And all the consequences that I alluded to before about Chrysler would have happened, except multiplied. I'm not here to tell you that we shouldn't have democracy. I'm not here to say that we don't need a Congress, but it was a real eye-opener for me how difficult working with Congress can be and how hard it is to get stuff done, and how much when people blame the president, either president, any president, for the problems of this country, frankly, they should be turning a lot of their attention to Congress, because the president really has much less power than you would imagine. Our founding fathers were not, they had a purpose in mind in establishing Congress at the Capitol on the top of the hill and the president in the White House at the bottom of the hill. That wasn't a complete accident. And so it's just something we all need to think about. Congress mostly left us alone happily. When they finally focused on autos, it was only because of the dealers who, we closed a lot of dealers, and Congress got infuriated by that. And so in the summer of 2009, they spent a lot of time having hearings and calling us up to explain why this dealer was being closed or that dealer was being closed, stuff that we actually had nothing to do with and that was being done thoughtfully. But it was sort of an odd juxtaposition that the one time Congress decided to focus on autos, it was over dealers, which in our minds were not the central part of it. The last thing last point I wanted to leave you with is that this was really the first time I had spent a lot of time in the manufacturing sector. Clay and I did media and telecom stuff at Quadrangle. It was most of what I did in my career. And we could have a whole discussion about the manufacturing sector, but I did come away really very much appreciating and even scared about the state of our manufacturing sector. Really not through our fault, but we are competing in a global world now. We're competing against other countries that are very good at getting better and better at doing a lot of the things that we used to be on our own level in doing. And it's had its impact on our manufacturing sector, and in my opinion, it's going to continue to. I'll give you just a couple of quick little anecdotes that struck me in the course of this that I talk about in the book. One was talking to Fritz Henderson, who was the CEO of GM after Rick for a while. And GM had plants in Mexico. It has a very thriving business in China. It has operations in India. And I said, Fritz, what do you pay outside the U.S.? So in the U.S., the base wage for UAW workers is $28 an hour. In Mexico, they pay $7 an hour. In China, they pay $4 an hour. And in India, they pay $1 an hour. And I said to Fritz, so what's your productivity like in Mexico? And he said, it's at least as good as the U.S., maybe better. And so this is what we're up against. The other sort of vignette that stuck in my mind that I talk about in here was one day, I think it was in March sometime, Delphi came in to see us, the executives of Delphi. Delphi, as you all probably know, was GM's parts operation. It was spun off by GM in 1999. It went bankrupt about 3 or 4 years ago. It was sort of sitting in bankruptcy for several years. And they came in as one of the many suppliers who came in to see us to tell us that they were being kind of crushed by the problems at GM and Chrysler, and could we help them? And so they were kind of making their case for help. And they were Delphi is based in Troy, Michigan. They were very earnest, solid Midwestern kind of folks. And I'm listening, and I don't know why it popped into my head, but at one moment I said, how many people do you guys employ? And the numbers are here, but the answer was something like 135,000. And I said, and how many of them are in the US? And they said 15,000. So Delphi, this quintessential American company, had quietly, carefully, deliberately moved 90% of its workers offshore. So this is the challenge we face in manufacturing, and we can, again, have a lively debate about whether we should do more or less to help manufacturing, but I just think we should be mindful of the fact that it is a challenge. Let me close, because probably some of you are wondering what the scorecard was on our adventures in auto land. I mentioned that we invested $82 billion in these companies. If you look at where GM stock is trading now, if you look at how GM values its stake in Ally Financial, the old GMAC, which actually was our second biggest investment after GM, a bit larger than Chrysler. If you look at the valuations that are out there on Chrysler equity, the U.S. taxpayer, as we sit here today, would recover about 85% of the money that was put up. So in other words, a loss of potentially around $10 billion. I continue to believe that there's a lot of upside in this sector. It's hit a bump in the road, no pun intended, the last few weeks because of the oil price stuff. The shares are down. But I think generally the trajectory will continue to be up, and so I think we could actually do better than that. But even if we end up losing $10 billion, I would argue that $10 billion was money well spent to save the sector, because not only would we have lost Chrysler, we would have lost GM, we would have lost the suppliers, we would have lost actually Ford because they wouldn't have been able to get parts, at least for a while. And it would have been an economic calamity akin to what would have happened if we hadn't saved the banking sector, and I think devastation across much of the Midwest. So I'm proud of what we did. I'm proud of the president's decision to do what he did, and glad to be here to tell the story, and happy to spend what time we have left on questions or comments. Yes, sir.
I'm interested actually on that last point, sort of about alternative scenario planning and to what extent you played out what would happen under each scenario, because my intuition would say that you wouldn't necessarily lose all that those assets are not going to just sit there lie fallow. They're going to be bought up by either foreign auto companies or Ford. The parts suppliers still need to supply. I mean, there is a sort of intrinsic demand for autos. So to what extent do you have this sort of scorched earth, no one's left around, or do they just transfer under different ownership, and how does that change the decisions that you guys made?
That's a great question. So with respect to the overall decision to intervene, we honestly didn't have the time, and we were too terrified of what the result would be to sort of say, well, what would happen if we did nothing? I just gave you a real capsule at the end of what I think would have happened if we had done nothing, which would have been GM and Chrysler would have run out of money at the end of March of 2009. They would have closed their doors. They would have stopped paying people.
How could you make that statement? They're not going to close their doors.
They would have closed their doors.
You've got all these brands.
They would have closed their doors.
They told you they would have closed their doors. Just like they arrived without a plan. You think you think that the CEO, you don't have much better than the CEO, right? But are you really even subtract, right? So that means he knew exactly when he was going to.
Can I respond to that point first?
Yeah.
No, actually, well, go ahead.
He knew exactly when he was going to run out of money.
No, he didn't actually. They had no idea when they didn't run out of money. Cladding?
Yeah. From having seen the very nitty-gritty balance sheets of these businesses, they had absolutely no idea how much cash they had. Oh no, I know.
Or the alternative is he knew the government was going to bail him out, so he needed to spend all that money.
No. Look. The CFO of GM.
You're talking about the CEO of GM.
Excuse me?
You're talking about the CEO. It's kind of hard to become a CEO.
I'm talking about the CFO for a minute. The CFO of GM could not on any given day tell us within $500 million how much cash they had. They did not have the systems to know. As a result, they said they needed $11 billion of cash to operate, and they should have been able to operate on $6 billion of cash or some number like that. They didn't know. They really didn't know. If you don't believe, what?
Did you know? I mean, you just told us you were an auto guy. So you know more than the guys who were running the automobile companies. I mean, it just doesn't seem to be very. I mean, there's another explanation which they didn't want to tell you.
I don't know how many times or how many ways I can tell you. They didn't have any money. They could not have paid their people.
They didn't have any money, but they did that intentionally.
You think they did that intentionally?
Well, you were ready to hand him extra money.
You think that GM basically ended 2007 with $30 billion of cash and spent all that money on purpose so that the government would bail them out?
Well, that explanation could be. I mean, you've got $30 billion. Think about it. You've got $30 billion. You just pay it out to shareholders.
Sir, with all due respect, you hijacked my question.
In fairness to everybody else who paid the $12 to come to this meeting, why don't I answer this gentleman's question? So the answer is they would have closed their doors. They would not have been able to pay their people. They would have all lost their jobs that day. The suppliers were actually in worse shape than GM and Chrysler because their business had fallen off just as much, right? But they hadn't gotten the $17 billion at the end of 2008. So that's why we heard from the suppliers, actually. The first thing we, in fact, did was a supplier kind of guarantee program, which was, frankly, more optics than substance because we didn't feel we could help every company in this industry. But the suppliers were in tough shape, and they would have, most of them actually did end up going bankrupt, but restructuring in bankruptcy. But they would have closed their doors. The dealers would have temporarily closed their doors. And, we can debate the number, but I think you would have had a couple million people out of work very, very quickly. Now, your point is completely right, and we did do a lot of analysis around Chrysler on this point, that obviously people would have picked up some of that business. So, for example, and Clay will help me, I think roughly half of the business of a typical car dealership is actually repairs. It's not selling new cars. So obviously people are going to still have their cars repaired. So some of those people would have kept their jobs or been hired back. Some part of a car dealership is selling used cars. That would have continued. You are correct that, for example, the Jeep line that Chrysler had, we thought was worth a fair amount of money and would be sold to some European. But would they keep making Jeep in the US? Or would they simply take the nameplate and make the cars wherever they happen to be based and send the cars to the US? Who knew? So you're right that there would have been a gradual process. You would have had a sort of one-time loss of this huge number of jobs, and then a gradual process of the jobs coming back in one form or another, because as you implied in your question, the number of cars that would be sold in the US would probably not change very much. It's just a question of who was going to sell them. But in our view, it would have been a long, painful process. There would have been certainly permanent loss of American jobs because Ford was in no position. Ford was worried that they themselves were going to go out of business. They were in no position to buy anything. So it probably would have been some non-US entity. And we don't know at the end of it how many jobs would have remained. Just like, look, we don't know if we had not bailed out AIG, we don't know what would have happened. If we had not put the TARP money into those banks on Columbus Day, that Hank Paulson put the money into. We don't know what would have happened. We just felt it was an unacceptable risk to take as some kind of social experiment to say, let's let Chrysler and GM go out of business or run out of money, and then we'll see what happens. We just didn't feel that that was the responsible outcome when we had an alternative that we felt was financially viable and relatively small financial exposure for the American taxpayers. Yes, in the back.
Hi, thanks for coming. You alluded a little bit to the potential firestorm that the administration had over the sweetheart promote that the unions got over the bondholders. Can you talk a little bit more about the politics there and divvying up the restructuring and dealing with bondholders and how that all came out?
And can you explain that that was consistent with law and precedent while you're at it?
Okay. So when people raise that issue, they're generally talking about Chrysler. And Chrysler's capital structure essentially consisted of $6.8 billion of senior secured, so-called secured debt that was actually a bunch of banks. It was 46 or 7 banks. There were no bondholders actually technically in Chrysler. And then there was some second and third lien debt that was held by a little bit by Daimler, a little bit by Cerberus, a bunch by the US government. And then obviously there was equity. So the challenge with Chrysler was that the $6.8 billion of senior secured debt was not really secured by anything. It was sort of notionally secured, but Chrysler didn't have $6.8 billion worth of assets. Chrysler's value in liquidation was $1 billion or less, in our opinion, and JP Morgan would agree with this. So essentially the first question was, what was the fair recovery for those banks? The debt was trading at 15 cents on the dollar. That's roughly $1 billion valuation. As I said, our view was that if we simply handed the keys to those banks, which is one way to handle a bankrupt situation, they would have not gotten more than $1 billion out, and probably they've acknowledged, when I talked to them in the course of doing the book, they acknowledged it was actually probably less they would have gotten out. So we paid them, in the end, $2 billion of cash to go, basically to go home. And it's also normal in a bankruptcy, as you all probably know, for the banks not to get cash, but to get more paper. So we actually were incredibly generous with those banks relative to what they were entitled to. And in fact, Jamie Dimon at JP Morgan, when I talked about this months after, said to me, my problem is not with what we got. I think we were treated fairly. My problem is with what the UAW got. So let's turn to the UAW. And I would start by arguing that, frankly, what the UAW got is none of his business. In other words, he got at least as much, I would argue substantially more than what he was entitled to get or would have gotten under any other circumstances. We made a decision. The UAW had a $12 billion claim against Chrysler for what was called a VEBA. It was for the famous retiree health care benefits that you've all read a lot about. The companies actually, to their credit, had done a good job before we showed up of putting a box around these open-ended health care liabilities, and by doing a deal with the UAW in which they both agreed to put a fixed amount of money into a trust that would pay these health care costs, and in return for that, that would be all the companies had to pay. There could be no further retiree health care liability to the companies. In Chrysler's case, it was a $12 billion obligation. They had funded, I think it was $1 billion more. They had funded about $1 billion, I think, and I think there was $12 billion left. It's an unsecured claim against the company. We could have wiped it out. We could have basically said, you're down in the capital structure, and I hope this all makes sense to you guys. I assume you're in business school. Hopefully it does. So we said we could have wiped that out. But we felt that if we did that, we would simply not have workers to do this job. That essentially this was all part of a negotiation. And in order to reach we were asking the UAW to make a lot of sacrifices, but asking them to wipe out all the retiree health care funds, which would affect obviously the retirees, but also the people who are still working there, was simply a bridge too far. And so we converted half of that into a note and gave them equity for the other half. And that happened to be 55% of the equity of the company underneath a huge mountain of debt that was still sitting on top of it, of US government debt and other debt. And our view was that that equity was not worth a huge amount at that point in time. We hoped it would be worth more later, but we didn't put a lot of value on it at that moment. But we felt it was something that was important to do to have an acceptable arrangement with the UAW. And there is precedent for this. in my colleague Ron Bloom, my deputy, had done a whole bunch of steel industry bankruptcies, and in many of those actually had VEBAs like Chrysler, and in those cases, in some of those cases, those VEBAs also got equity in the company as part of their compensation in the restructuring. So it was litigated all the way to all through bankruptcy court, all through the Court of Appeals, all the way to the United States Supreme Court, and essentially every judge said what we said, which was that the key element is that every creditor got at least as much or more than they were entitled to get or would have gotten in a normal bankruptcy. And the fact that some got more than they would have, this much more than they would have gotten, and some only got this much more than they would have gotten, isn't really a litigatable issue. Everybody got at least as much or more than they would have gotten, and that's why we thought it was fair. And there were no politics around it. I mean, honest to God, I was never told by the White House to do anything about the UAW other than what we did. And in fact, at one point, Ron Gettelfinger wanted to go in and see the president of Rahm Emanuel, and basically they said, look, the auto team is doing this, and deal with them. Yes, ma'am.
Thank you. So I'm curious as to how you and your team approached setting new precedent as you went through this. You talked a little bit about looking backwards at existing law and precedent, but how did you think about what you were doing at the time being a potential future model for similar cases?
Actually, we thought about it a lot, and Larry Summers particularly thought about it on our behalf, maybe in the opposite of the way you mean your question, which was we really did not want to set a precedent for the government intervening in the private sector. We all thought we were pretty smart. We all thought we knew what we were doing. But none of us, but I'm sure we didn't know as much as we thought we did, but in any event, none of us liked the idea that the next group and the next group and the next group, that any industry could come in and say, do for us what you did for the car companies and get government money. We hated that idea. Just the way we hated, what my Vietnam analogy, just the way we hated the idea of having a long-term ownership position in these companies, which is part of why GM went public so quickly, was for the government to be able to sell. We viewed ourselves as investors of last resort. If there had been any private capital that wanted to come in instead of us, we would have said, it's all yours. We didn't want to be here or to do this. And so our goal was to leave as light a footprint as we could, to be in and out as quickly as we could, to have as little to do with running these companies as we could, to have these private sector boards, and frankly, to set as little a precedent as we could for future involvement, because we believe, rightly or wrongly, even as Democrats, that the government, to the maximum extent possible, should stay out of the private sector, especially the industrial sector. We didn't believe that any of us had the wisdom to override the kind of decisions of investors and the marketplace and capitalists who are allocating capital. We didn't think the government should be doing that. Yes, sir.
Yes, but there was a precedent in 1980. Chrysler applied for a government bailout, received it. So what extent were you influenced by that?
There were a few precedents. Chrysler, I think it was actually 79, maybe it was 80, and Lockheed was one. Conrail. There are certainly a few precedents for the government stepping in under extreme circumstances. We were not particularly influenced by that early Chrysler precedent. And I would argue that each of those, I don't know enough about all of them to kind of evaluate whether they were the right or the wrong thing. I would argue that I hope the people who made those decisions in those cases basically made the same decision we made, which was it was a systemic risk, call it too big to fail, call it what you want, that it was just too much of a risk to put on the economy at that particular moment in time. But again, I think the number of cases like that is a small handful, and I think it should stay a small handful, and I think it should only happen under the most extreme circumstances. And hopefully, part of what I've tried to say in the book and what I try to say in these talks and what we've said publicly and the president said publicly is we just want this to be the exception and not to have people feel this is the beginning of this is not the long arm of government. This is not creeping socialism. This is not Obama Motors. This is sort of a decision that we just had to make, but wish we hadn't had to make. I think you had your airtime. With all due respect.
Thank you for coming. Looking back on some of the past governmental policies and I'll say protectionist policies, from an outsider's view, do you think that some of those policies put Chrysler, GM, the situation they are today, and kind of, although it helped in the short term, kind of hurt them in the long term, where they needed to be in the situation.
Like which kind of policies?
Some of the trade agreement, trade protection agreements that they had, they specifically South Korea, for example, and like Malali kind of went against Bush's free trade agreement to get some protection there. I mean, do you think that we were disadvantaged because of those?
You know, look, the whole thing, when I was a reporter at the New York Times, actually, I covered a little bit the Chrysler bailout in '79 or '80, and you know, during that period, there was a lot of debate about the Japanese and whether it was fair trade or free trade, and whether we were kind of been taken for kind of suckers or not. And there was some. In fact, part of the reason the Japanese started assembling cars here was they were afraid that we were going to put import quotas on them, and therefore they'd be shut out of the market. And so they started. One of the reasons why they started assembling here was to avoid that possibility. Look, one of the things, and this gets back to my sort of management matters theme of that article that you all have. One of the things that struck me in the course of this is the fact that GM had this huge problem. You know, we put $50 billion into GM. GM actually turned out was in some ways in worse shape than Chrysler, even though it was a much bigger kind of company. Proportionate to its revenues, it got more capital than Chrysler. And so here you have GM that ran through $30 billion in 15 months and literally did show up having run out of money. Ford did get into trouble, as I said. You know, Ford had a tough brush, but Ford got through it. And Ford had, you know, huge profits last year, near record profits last year, and never needed a government handout. And so the question is why? Why, you know, they're playing exactly the same set of cards, right? Same UAW contract, same Japanese competition or South Korean competition, same oil prices, same credit crisis. So why is Ford doing so well and GM isn't? And the only conclusion I can come to is management. So I can't tell you that every policy decision the government made over the last 40 years about autos helped or hurt or was right or wrong, but I do think that a fair amount of the trouble that Detroit got into was of its own making. And the difference in how the three companies went through it does reflect the quality of management and the strategic decisions they made along the way. Yes, sir.
It's truly management, as you say, that sort of distinguishes whether this company is going to, an auto company is going to succeed or what. Why didn't the private sector step in earlier? I mean, I could imagine like a private investor recognizing that there's apparently a depressing value in this particular management stepping in. I mean, is there any inefficiency in our takeover market here that sort of could have prevented this problem at an earlier stage?
You know, I don't know if it would have prevented the problem. I was with you till that last part, but we can come back to it. But one of the things that Larry Summers and I used to debate, and I shouldn't be debating Larry Summers about anything, but at least in this one area, I felt like we were kind of on neutral territory, which was the sort of efficient markets hypothesis, which actually Larry has argued both sides of at different times in his career. And you know, I respect markets. I'm a private sector guy. But I also think markets don't always work. And in March of 2009, you could have bought Ford stock for $1 something. It was up to 18. It's now at 14 something. So there was a case where private capital could have said, this is a great opportunity, let's come in. And they would have made a lot of money. Even when we put $30 billion into GM, of the $50 billion, $30 billion went in on June 1st when GM went into bankruptcy. And the first 20 was kind of lost if you sort of follow the normal bankruptcy process. That $30 billion was what bought us our 60% of the equity. If anybody had shown up and said, I want a piece of that $30 billion, we would have said, great, here, take it. You know, that $30 billion today is worth 40, 45 billion. You know, it's not 10 times, but it was a very good investment that we made on June 1st. So I think markets can be inefficient. And this, I guess, is, you know, to the good questions that you all have asked about precedent and about when the government should intervene. Markets do fail, and I think, you know, we can debate the financial rescue, the bank stuff, and I have views about all that, but I think broadly speaking, there are moments when government does have a role to play, when markets do fail, when private capital isn't being allocated efficiently or intelligently, and you see some of that going on. You know, Europe is going to face those decisions over the next few weeks about what they do about Greece and Portugal and Ireland, same kinds of decisions. So they're tough decisions. They're really tough decisions. I do think that both the Bush administration and the Obama administration really got most of them right in this case. But I think these kinds of interventions should be the exception, not the rule. Yes, sir.
One more. Given that summary, would you suggest that it's misplaced to try and stop the too big, try and have a policy to prevent that? It's just that government has to play a role that steps in from time to time, and you can't really avoid that.
I do think when we're on banks, which as I said, I have plenty of opinions about. I do think that the notion of too big, of trying to avoid the necessity of government ever intervening by reducing every institution to whatever is considered to be the maximum size that makes them not systemic is not practical. The example I like to use is LTCM in 1998 was not on anybody's list of the 25 biggest institutions or most important institutions, and it almost brought down the whole financial system and required a fairly dramatic intervention. The Canadian banking sector is far more concentrated than our banking sector is, and yet they got through all this without needing the government to intervene. So those are two examples on either side of the question. I think obviously a lot of mistakes were made in deregulating the financial sector. It is integral to be allowed to just sort of run amok, and whether the Dodd-Frank stuff and all the pieces of it, the Volcker Rule and so forth, are exactly the right things or not, time will tell. But we had, I think some of what we did was right, but nobody should kid themselves that either Dodd-Frank or what we did in autos or breaking these companies down would avoid the need for government to ever intervene. That's part of why you have government, is to deal with extraordinary circumstances. And I've said a couple times, I'll say it one last time, what we should all hope and pray for is that our leaders in the future are thoughtful about when they do choose to intervene, because I do think it should be by far the exception. And obviously when you do it, you want to do it right, as I said, as I think both administrations have done over the past couple of years.